Welcome back. So tonight we are back with the economics. My guests are two very interesting people. I have Acheampong, who is the chief analyst for Blackstar Global, one of the world's leading investment advisory firms. Acheampong is a master of using graphics to tell stories, and he's answered two questions for us. The nature of the appreciation is very interesting. It's against the three major trading currencies, the euro, the dollar, and the pound. He's given us a very good historical analysis of the quarters redenomination. CD has lost 93% of its value since redenomination, average of 15% depreciation per year. And the time series shows that the CD is always trending downwards against the US dollar. I wanted to put up a quick chart to summarize where we are before I bring in Theo. Theo will help us with question 3, and question 3 is essentially what is driving this current surge. But I found this on Bloomberg today, and basically they've put the CD, and this is very easy to see. Let me just show you this. So this is how many CDs you need to buy a dollar, all right? And you can tell that since May last year, you've needed an average of 15 CDs to buy the dollar. But from the second week of April, it's come down to around 12-ish, 13-ish CDs. We are praying it gets to 10, which is what it was probably end of 2024. And there's an interesting relationship between how many CDs you need for a dollar and the rate of inflation year on year. I'm not going to go into inflation, but that's a different conversation. But you can tell that at some point there appears to be some correlation, because as inflation trends downwards, the amount of dollars you need, CDs you need to buy a dollar, trends downwards. Some people say that it's because some of our inflation is imported. So if you are producing goods in a country and the raw material is bought in dollars, the cheaper the dollar, the cheaper your input. And the cheaper your input, the lower your price. So there's a certain relationship between inflation and the currency, but that's not why we are here. I wanted to bring Theo in. Theo, thanks for joining us. Are you in London? Are you in Loughborough? Are you in Lisbon? Where are you?
I'm in Scotland.
Oh my God. Great. So what is driving the recent appreciation of the Ghana cedi against its major trade partners?
Yeah, thank you once again, and it's a very important point that you've asked. And I think to really do justice to this, we need to unpack it, for me, into two broad strands. What is happening externally? So basically what is happening in the markets outside with the Trump policies and whatnot. And then we also look at what is happening domestically or internally within the Ghanaian front. And then when it comes to that, I'll talk about two specific aspects of that, on the fiscal side and then also on the monetary side. And in the graph that you just showed, the Bloomberg chart and the other currency chart, what is very clear is that hitherto April of this year, we had seen the cedi trading relatively around 15.5 thereabouts to the dollar. And then we've seen this big sharp drop in the last 2.5 or so weeks and counting. And when I analyze it very carefully and look at the dynamics and the drivers, what is very clear to me that the sharp drop that we're seeing cannot be fully explained by what is happening on the global market. In other words, the Trump-induced economic uncertainty and the decline in the dollar, that does not fully explain what we are seeing on the market. Because in any day, you saw the Liberation Day was on the 2nd of April. And normally, the way these currencies trade and the signal mechanisms associated with that, if you are going to have a pass-through on the external side to the local currency, in this case, the cedi, that would have actually been picked up in the signal very early on, rather than what we had seen just about 2.5 weeks ago. And that's one important first point to note. The other important point, and which is more fundamental to the decline in the dollar rate. In other words, the appreciation of the cedi that we are seeing, in my view, largely rests on the monetary policy measures that the central bank has been taking, and to an extent what is happening on the fiscal side of the equation. So let me maybe take a bit of time to expand that a little bit so that our viewers can appreciate it a lot more. So on the fiscal side, we have seen a lot of momentum, a lot of steps that the government has taken to try and restore investor confidence. We saw the 2025 budget. We saw some of the spending cuts associated with that. The IMF just reviewed the fourth review of our current ECF program, and that is going to bring in some additional funding. At the World Bank IMF spring meetings, there was a lot of relative positive sentiment from the investor community as to the turnaround that we're seeing within the Ghanaian economy. And even on the inflation as well, if you look at the data points as you put out there, you actually see that beginning to cascade or come down as well, related to the imported inflation component. Again, I would say that the fiscal measures does not fully explain all that we have seen, because the rate of change has been that drastic just within the last 2.5 weeks. So that then brings us really to what is the heart of the issue on the monetary side, right? What is it that the central bank has done, or maybe not even done, to actually allow us to see a relative improvement in the value of the cedi compared to the dollars? And this is where the sales of the gold reserves becomes really important in terms of the additional forex inflows that have been coming through to the market. You look at our export data for gold, and you look at the data from as published by the central bank, and it's actually quite clear that in the last several months of this year, we have actually exported relatively more gold, and therefore gotten a bit more forex inflows to actually support our reserves and support the currency. And this is, for me, if not the most important factor that is driving and underpinning what we are seeing on the FX front. You can also see, again, some additional dollar inflows that have been provided to cover payments within, or that are due within, the energy sector. So particularly for the IPPs, for fuel purchases, and this is actually a bit more than what ordinarily is made available to them. And all these additional dollar inflows that have come in within the relative 2 to 3 week period that we're talking about, then means very basically you've got a bit more dollars that are within the system than you do need. And that is what is pushing the pressure to actually drive down the exchange rate. So I just took a bit of my time to explain.
All right. So I wanted
the external side. You have some movement, but that has not fully explained that. Yeah. It really comes down to the domestic factors.
Good.
And of the two domestic factors, monetary, fiscal, in this case, it's really the monetary that is driving a lot of the movements that we're seeing.
So I wanted you to speak to what I've put on the screen, because I think this is what you were trying to say, that our gold reserve position, because you're talking about the monetary part of this. So are you saying that the probably the most important factor for the appreciation is the fact that the central bank has been able to bolster its gold reserves, or it has
bolstered and then it has also sold? So look at the chart,
yes,
you could see on a month-on-month basis,
yes,
right, going all the way back to 2023 under the NPP.
So you're talking about the chart on top, this one, the one on top,
the one at the bottom,
the one at the bottom.
Okay, that actually shows you the net addition.
Wonderful,
right? You can see very clearly, almost every month, there is an addition to the gold reserve. So if you take those lines and you plotted it to the end of December 2024, you can actually see the incremental month-on-month additions.
Okay.
Now observe, from January 2025 onwards, there is still some addition. However, it is not at the same pace or level as the months before, right? So what you're actually then seeing in terms of the net is that you're actually selling some of those reserves to get forex inflows, but it is not what the net is not as big as what you were adding originally in terms of bolstering it, right? So what this is basically doing, or what is allowing you to do, is you are in a much better position now than you were, say, 2 years ago, even a year ago, to actually make active interventions in the forex market to support your currency. And I mean the data for me is quite clear on this aspect. So what has happened really is that in the last 2 years we have built up quite significant reserves, and there's even more that can be done. But now we are in a position where you can decide to actually sell some of those reserves, get dollars, and use that to support your local currency.
So I remember I interviewed Kofi Aka, who's an analyst. This is
our good friend Kofi, yes.
And he urged the government to increase what is called ORR, optimal reserve ratio. At the time he wrote the article, the ORR was around 7%. And the time I interviewed him, it had gotten up to probably 30-something%. And his point was that increasing your gold reserves was the best way to strengthen your currency. So in a sense, they listened to him, and this is why we've seen what you're seeing. Now, are you saying that having built those reserves, we are now in a better position to sell some of that, to get dollars, to reduce the pressure on the cedi, which is what we've done in the past couple of months, to then strengthen the currency? So basically, the gold reserves was the bedrock, and now, so it's like the strategy. And then the selling is now the tactic. If I'm trying to make sense of why we are here, is that what you're saying?
Yes, but you also have to keep accumulating reserves. So you cannot just be selling all the reserves and you realize that you have nothing, right? And in the environment that we are in now, where gold prices are trading around what, 3,300, I've seen some forecast of even possibly $4,000 an ounce by the end of the year. What that actually allows you to do is to do both of the two things at the same time. So you increase the reserves, but you also have enough that you can actually sell some to get the dollars that you need to prop up your currency. And that optimal mix, or that optimal ratio, per the literature, per some of the evidence, in some jurisdictions, they are going 40%. Some even say you should go up to 60% in terms of that optimal mix. But the important thing is that you build the reserves. You are in a position where you can sell some. You are not selling everything. You can sell some as and when needed to allow you to actually get additional forex. That is more like a short-term, right, or medium-term measure. The more longer-term structural measures comes down to the things that we have been talking since independence: diversifying the economy, making sure that you can actually export and you are competitive, and all of those. Those are more deeper structural things that need to be changed.
I'll take a break. When I come back, I'll ask my guest in the studio to comment on your analysis. Then we'll ask the final question for the day: how long will this surge in the cedi's strength last? This is the point of view. We're speaking to two analysts on the recent surge in the cedi's strength against the US dollar. Stay with us.